October 29th, 1929. A single date that changed America forever. Imagine waking up rich and going to bed broke. For thousands, this wasn't imagination, it was reality. What happens when an entire nation's wealth vanishes almost overnight? How does prosperity transform into despair? The crash wiped out 89% of the market's value, collapsed 9,000 banks, and left 1 in 4 Americans unemployed. Ready to discover how a stock market collapse triggered the most devastating economic catastrophe of modern times? The 1920s roared with unprecedented prosperity. America emerged from World War I as a global superpower, transitioning from a wartime to consumer economy practically overnight. New technologies transformed everyday life. The assembly line revolutionized manufacturing. Suddenly, ordinary Americans could afford cars, radios, and refrigerators. Industrial output soared by an incredible 50%. But beneath this glittering surface lurked dangerous realities. While the wealthy embraced the jazz age and speakeasies, 40% of American families lived below the poverty line. The top 0.1% of Americans possessed income equal to the bottom 42%. This extreme inequality created an unstable foundation. Meanwhile, Wall Street became America's new obsession. Stories of ordinary people striking it rich in the stock market spread like wildfire. Why work for decades when you could multiply your money in months? Everyone wanted in factory workers, farmers, teachers, doctors. The stock market seemed unstoppable. Between 1921 and 1929, the Dow Jones Industrial Average grew sixfold, from 63 to 381 points. Respected economist Irving Fisher confidently declared, "Stock prices have reached what looks like a permanently high plateau." He couldn't have been more wrong. What made this financial house of cards so vulnerable? 5 critical weaknesses created the perfect economic storm. First, speculation reached fever pitch. People weren't investing, they were gambling. Most troubling was buying on margin, putting down just 10% and borrowing the rest. When stocks rose, investors made fortunes. But what would happen if stocks fell? Second, America was drowning in its own success. Factories and farms produced far more goods than people could buy. Warehouses filled with unsold inventory, while farmers watched crop prices plummet. Third, America's banking system was dangerously fragmented. Over 25,000 independent banks operated with minimal oversight. If one failed, it could trigger panic at others. Fourth, the Federal Reserve, still a young institution, made a critical mistake. Worried about speculation, they tightened monetary policy in 1928 to 1929. Instead of calming the market, they starved it of needed liquidity. Fifth, international economic problems lingered from World War I. European nations struggled with war debts while America erected high trade barriers. Warning signs flashed throughout 1929. Construction slowed. Steel production declined. Car sales dropped. The market became increasingly volatile. Yet most Americans remained blindly confident. The bubble had to burst. But would it deflate slowly or explode? Thursday, October 24th, 1929. The nightmare began. The market opened with an immediate 11% plunge. Panic spread across the trading floor as a record 12.9 million shares changed hands. Margin calls went out. Investors who had borrowed to buy stocks now faced devastating choices: pay up immediately or watch their holdings get sold at rock-bottom prices. Wall Street's most powerful bankers rushed to an emergency meeting at J.P. Morgan's offices. They pooled millions to stabilize key stocks. By day's end, they'd seemingly stemmed the bleeding. The next day, President Hoover assured Americans, "The fundamental business of the country is on a sound basis." But Tuesday, October 29th, soon known as Black Tuesday, shattered all illusions. The market collapsed spectacularly. A record 16.4 million shares traded hands. Blue-chip stocks fell 40% in a single day. General Electric, AT&T, RCA. Titans of American industry all in freefall. By mid-November, the market had lost $30 billion in value, equivalent to $474 billion today, and more than all the money America had spent fighting World War I. The question haunting every American: was this just a market correction or something far worse? Fear raced through America faster than news of the crash itself. If Wall Street titans could lose everything, was anyone safe? People rushed to withdraw their savings, but banks had invested those deposits in now worthless stocks or made loans that couldn't be repaid. When too many customers demanded their money simultaneously, banks simply ran out of cash. Lines formed outside banks nationwide. Those lucky enough to arrive early got their money. Those who didn't lost everything when the doors locked permanently. The crash might have remained a Wall Street tragedy, but 5 critical mechanisms transformed it into a national catastrophe. First, the wealth effect. When people lose money, they spend less. When stocks collapsed, so did consumer spending. Second, the banking crisis. As banks failed, they took their customers' life savings with them, further reducing purchasing power. Third, confidence collapsed. Businesses canceled expansions. Manufacturers stopped production. Retailers canceled orders. Investment disappeared. Fourth, the contagion went global. American banks recalled foreign loans. International trade seized up. By 1931, the crisis had spread to Europe, triggering bank failures in Austria, Germany, and eventually Great Britain. Fifth, instead of fighting the downturn, government policies made it worse. What started on Wall Street now infected Main Street everywhere. How bad did it get? The numbers tell a shocking story. U.S. GDP plummeted from $103.6 billion in 1929 to $56.4 billion in 1933, a 45% collapse. To put this in perspective, during the 2008 financial crisis, GDP fell just 4.3%. Unemployment skyrocketed from 3.2% to 24.9%. 1 in 4 Americans who wanted work couldn't find it. World trade cratered by 66%. Consumer prices fell by 25%. Sounds good, except businesses couldn't make profits, so they fired workers or closed entirely. Former President Calvin Coolidge captured the nation's despair. In other periods of depression, it has always been possible to see things which were solid and upon which you could base hope. But as I look about, I now see nothing to give ground for hope, nothing of man. What had once seemed unthinkable was now reality. America was in the grips of the Great Depression. But why didn't the economy recover naturally? What turned a severe recession into a decade-long depression? President Herbert Hoover wasn't the do-nothing president history sometimes portrays, but his actions proved catastrophically inadequate. Hoover believed business leaders would voluntarily maintain wages and employment. He famously declared, "Prosperity is just around the corner." But businesses were fighting for survival. Voluntarism failed. 3 major policy mistakes deepened the crisis. First, the Smoot-Hawley Tariff Act of 1930 raised import taxes to record levels, supposedly to protect American jobs. Instead, other countries retaliated with their own tariffs. International trade, already struggling, virtually collapsed. Second, the Federal Reserve failed in its most crucial role. Instead of providing emergency cash to prevent bank runs, it allowed thousands of banks to fail. Between 1929 and 1933, approximately 9,000 banks collapsed, taking $7 billion in deposits with them. Third, Hoover clung to balanced budget principles when massive government spending was needed. He eventually approved some public works, but too little, too late. As the crisis deepened, Americans grew desperate for new leadership. Statistics can't capture human suffering. Behind every number was a family in crisis. Bread lines stretched for blocks while soup kitchens struggled to feed millions. Rural families survived on foraged plants. Thousands lost homes, creating Hoovervilles of makeshift shelters. The Dust Bowl transformed the Great Plains into a wasteland. Thousands migrated west seeking scarce work. Suicide rates increased 30%. Malnutrition became common. Family bonds broke under pressure. Despite suffering, Americans showed resilience. Communities organized cooperatives and neighbors supported each other. Roosevelt won the 1932 election, declaring, "The only thing we have to fear is fear itself." His administration implemented the New Deal, transforming government with programs like the Banking Act, Glass-Steagall, separating commercial and investment banking, the Securities Exchange Act, creating the SEC, Agricultural Adjustment Act, addressing the farm crisis, National Industrial Recovery Act, funding public works, Social Security, unemployment insurance, and minimum wage laws. These measures stopped the economic freefall, though didn't end the Depression completely. Recovery improved until the Roosevelt recession of 1937 to 38 demonstrated fragility. World War II finally ended the Depression through massive government spending. Unemployment fell from 14% to 1.2% by 1944. Key lessons: financial markets need regulation. Monetary policy is crucial in crises. Government stimulus is essential during downturns. And extreme inequality creates economic vulnerability. The 1929 crash and resulting depression weren't inevitable. They resulted from specific policy failures, structural weaknesses, and human psychology. Understanding this chain of events helps us recognize dangerous patterns in our own time. Could it happen again? The 2008 crisis showed that financial contagion remains a threat, but the safeguards built after 1929 prevented a second Great Depression. What guardrails protect your financial future? Have we truly learned the lessons of 1929, or are we condemned to repeat them? If you found this historical journey valuable, support our mission to make economic history accessible to everyone. Like this video, subscribe to our channel, hit the notification bell for more fascinating economic stories, and share your thoughts in the comments below. What period of economic history should we explore next? Your engagement helps us create content that matters to you.